Yeah, welcome back to Arise Global Business Report. The National Assembly in Nigeria has finalized arrangements for the passage of the 2020 budget with the submission of reports by the committees and appropriation of both the Senate and the House of Representatives. However, going by the reports of both committees, the nation's expenditure profile for the new fiscal year would be higher than the 10.33 trillion naira President Muhammadu Buhari proposed to the legislature, while the Senate Committee on Appropriation increased the budget proposal by an additional 450 billion to bring it to 10.78 trillion naira. Its House counterpart raised the budget proposal by over 260 billion naira to bring it to 10.59 trillion. The budget report will be considered at Senate plenary by a committee of the whole headed by the chairman, Dr. Ahmed Lawan, through a clause-by-clause perusal of the proposal before being passed by the upper chamber. Nigeria's equities market has been on a downward trend despite gains recorded in previous weeks, while performance in the fixed income market has been mixed thus far. Joining me today is an investment analyst with AfriInvest Securities Limited, Oluwadra Olunuga. Oluwadara, how's everything? It's good to have you with us.
Thank you so much for having me.
Okay, so let's talk about the equities market performance and overall sentiment this week so far. What are your thoughts?
So basically this week, as against what we experienced in the last 4 weeks, where the market has been on a gaining streak for 4 weeks, 4 consecutive weeks, we've seen losses this week, probably due to profit taking in some stocks, due to losses in some other stocks. So on Monday, we saw a 4 basis point decline, and Tuesday, 17 basis points. Yesterday, 2 basis points, and today the market is on course to even lose yet again. But however, we have to note that when we saw gains, we suspected that it may be due to restriction in the fixed income market, and high system liquidity in the system. But however, this week we've seen gains. We have to note again that sentiments have been very weak in equities, basically. So investors are staying on the sidelines to see whether there will be macro buffers. By that, reforms, macroeconomic reports that can boost investors' interest in equities. Yeah.
So it was a bit of a mixed group,
yeah, mixed performance. Basically, the gains are very light. It's not so encouraging. Right. And then the losses, for last week, week on week, the market gained about 4 basis points cumulatively. So this week, we don't expect something so deep. We expect the market, the bearish sentiment is still here. Okay. It's not over yet. Yeah.
Very good. So how would you assess the performance of the fixed income market now in recent times?
Okay. From Monday, we've seen a mixed performance, basically, for the fixed income market. The bonds have been on the bullish trend on Monday, Tuesday, even yesterday. But for T-bills market, it has been a bearish note because yields have been rising in that space. And we already know that yields are in the single-digit zone, 7.5% on an average for the T-bills market. It's not really encouraging with a country that has an inflation of about 11.6%, but that's negative real interest rate. So it's expected that investors will always move towards the long end of the curve with the yield.
Yeah, no doubt the inflation has its impact on the market so far. So what are your expectations for equities and fixed income instruments for the rest of the year, you think? It's just 3 weeks or thereabout to go?
Yeah, a few days to go, yeah. So for equities, we expect this bearish sentiments to continue because even performance of companies have not really been encouraging. The banking sector that is coming up, the toast of investors have received a lot of letters from the regulators. So we don't expect too much for the equities market, but maybe towards the end of trading for the year, we should see portfolio managers picking a bit of stocks to rebalance their portfolios. Yeah. We can see investors picking interest in some stocks in anticipation of dividends. Because we know that stocks are at an all-time low now currently. And for those stocks that are dividend-paying, dividend yields are actually attractive. They're in the double digits zone. Compared with fixed income, where it's 7% obtainable in T-bill markets, it's 16%, 12% dividend yield would make so much sense to investors.
Yeah, and you can't help but think it's a little bit disheartening that you can actually predict what's going to happen in the market every now and then. And it's especially with this bearish sentiments recently.
There have been a lot of uncertainty, actually. So even as analysts, when we see gains, we try to know what is happening. But we know investors are cautious. we even advise investors to be cautious.
True.
So only for stocks that are fundamentally sound, for banking stocks that are poised for gains when there's a turnaround in the market, that's the only stocks we advise investors to key into.
Yeah.
I mean, buy stocks that are sure that there will be dividends declaration, dividend yield by March 2020, and then they are sure that they are poised for gains when there's a turnaround in the market, if there is a turnaround.
All right, still on the issue, according to the MBS banking sector report, how have banks fared in the third quarter of 2019 relative to the second quarter of the same year in view of the current regulations? We've been seeing waves and waves of them, and banks virtually trying to keep up their breath to catch up, as it were. So what do you make of it?
We know the banking sector is an heavily regulated sector in this our dispensation. They received a lot of love letters in quotes from the regulators. So we saw, according to the MBS reports that was released early this week, we saw loans in the banking sector grow by about 10%. In absolute terms, that's about 2.4 trillion naira to 25 trillion over the quarter between Q2 and Q3. We've seen that growth in loans. And then for deposits, we've seen a slight decline in deposits, about 0.8% to 26 trillion in deposits. And I mean, this is understandable. They received a letter in July with the minimum LDR at 60%. I mean, and another one in September. By the time they met that LDR, they received another one, increasing the same ratio to 65%. So we understand that as at September, LDR was at 62%, which means whatever the CBN is doing is already working. So seeing deposits having been stagnant and loan book growing is an indication of what the bank would do. I mean, banks are made for profit making, right? True. So if loans cannot grow, like we always advocate, deposits will have to be constant. I mean, we won't chase away deposits, but we'll be less aggressive on deposit growth, and then we increase our loan book just to meet up with the regulation. But another key point to note in the report is the non-performing loan ratio. So we saw non-performing loan ratio moderate significantly to 6.7% from 14% last year and from 9% in Q2. That is a huge one. I mean, if I was a CBN governor, I'll be very impressed that despite the increase in loan book, we are having moderation in NPL. But we have to state that this is sector-centric. So it's just the oil and gas sector that recorded a significant moderation in the loan. So non-performing loans, according to oil and gas sector, have been reducing. So if we have to take you down memory lane, I mean, when oil was discovered and the oil companies were doing well, they became the toast of banks. Banks were extending so much loans to oil sector. And in 2016, bam, we saw what happened. Oil price tanked to about 38%, $38 on an average. Oil production reduced to 1.2 million barrels per day. And then we saw the oil and gas companies scrambling and then trying to survive. Therefore, they were able to service their loans. There were a lot of loan restructuring activities with the banks during that period. But over time, we've seen significant improvements in oil prices. I mean, last year, oil prices averaged over $60 per barrel. And we've seen a significant increase in oil production because the Niger Delta migrants, or whatever distortion has been happening in that area, has calmed down. And so we're having production at about 2 million barrels per day. We're having oil prices at above $60 per barrel. So you should we've seen improved performance, especially for the listed players. We've seen improved performance on the part of the oil and gas, and they're paying down their loans, and then it's reducing NPLs. NPLs also reduced for other sectors like power, for like manufacturing. But for oil and gas, the non-performing loans reduced by 73%, from 1.1 trillion to about 236 billion non-performing loans. I mean, that's really significant year on year, from Q2 last year to Q2 this year. So that is what is driving the non-performing loans. So we think overall, non-performing loans is still a major risk for the banking sector, because this is just oil and gas. I mean, we have our infrastructural issues that are reducing the capacity of banks from lending to sectors like electricity. We've seen factories closing down because of electricity, because of a couple of other infrastructural deficits and structural issues. So we still need to flag this. That it's not yet a success story or something to be really happy about.
It's still an ongoing process, as it were. Okay, so what is your outlook on the banking sector for 2020 at this rate?
There are a lot of things that will shape performance in the banking sector in 2020. Regulation is number one. I mean, they need to keep looking out for the remaining love letters that they will need to receive next year. So, I mean, this new LDR is going to increase loan book. We may see likely uptick in impairments charges. We may see uptick in non-performing loans, and then reducing profitability of banks. So historically, income from loans and advances has been a drag to total income for banks. So it has always been income from investment securities that has provided that steady flow of income. So if you're asking them to increase loans at the expense of investing in fixed income, which is a sure source of income, so we see that may be a drag to overall top-line performance. But however, fee and commission income for the banks have been rising due to obviously improved use of electronic products. You and I continue to use our banking platform. I mean, how many times have you visited the banking?
Fintech is there for us.
So that line of income continues to grow, and we've seen banks restructuring their loan book, trying to maintain operational efficiency to see that as top line is not growing, expenses are not also growing, just to ensure that profitability is being returned back to shareholders. So another thing is, the CBN governor mentioned hinted at recapitalization. We don't know when yet. So if it's going to come, let's say next year, 2021, there will be adequate preparations. We should see a total overhauling of the banking sector, just like we saw in 2005.
Oh, just one-off question here. If one would have expected that, or rather the impression being given here is that if the banks didn't get the extra push from the CBN regarding, loans towards the real sector, we wouldn't have seen that improvement in the loan books, as you've mentioned earlier. Although it's mostly tuned to the oil and gas business
sector, and then manufacturing and all. Yes, naturally, banks are made for business, for profit making, like I mentioned. But
so it's a begrudging thing for them.
They should actually lend to the real sector because maximum lending rates is about 30%. But there are so many structural challenges. I mean, look at the small business, look at businesses that are closing down. So businesses are not able to service their debts. So they would rather go to fixed income and take 12% that they are sure that they can sit back and earn without stress, rather than loans that they have to do a lot of on-site evaluation, a lot of bookkeeping, a lot of record keeping, a lot of supervision, just to make sure that they get that rate. And at the end of the day, when you check the yield on loans, it's very, very low, and it is not encouraging. So if not for the push, you may not have seen the growth that we saw.
Indeed, and even talking about the issue of loan defaulters and the problem with and the anxiety being expressed by the banks, but are there enough mechanisms, you think, by the CBN, to actually curtail the number of non-performing loans, as it were?
Yes, there are some initiatives on the back of CBN.
Right.
So we've seen collateral registry. There are not transparent measures enough yet for us to say, yes, this is actually working. Like the collateral registry, where you have to register your collateralizable assets so that it will be easy for the banks to access how much you have, what is the worth of your assets before the asset they can lend to you. There's also this initiative of using the BVN to link accounts. So if you hold in Bank A, they are able to pull your money from Bank B and pay Bank A. But we need to see the full impact and implementation of all these policies to be able to, if they are transparency in the dealings of these organizations, we're able to measure how far they've been able to foster loans growth.
All right, transparency and accountability, very good. Oluwadara Olunuga of AfriInvest, many thanks for your thoughts on these issues. Always a pleasure to have you.
Thank you so much.